Welcome to Equity Merchants. I'm your host, Chimgozi Mukoma. Retail investing in Nigeria has grown rapidly over the past 5 years, with more everyday people looking beyond savings accounts to public and private markets. But despite that growth, participation still lags far behind the country's potential. So what will it take to bring more Nigerians into the investment space? One company that has tried to answer this question is GetEquity. The startup began by giving retail investors access to startup shares, but has since evolved, offering opportunities in established companies and shorter-term instruments. Jude Dike, co-founder and CEO of GetEquity, joins us to share insights into the evolution of retail investing in Nigeria, the role of fintech partnerships, and where the next phase of growth might come from. Retail investments in Nigeria have grown significantly over the last 5 years. What do you think is driving these shifts? Why are more retail investors getting into the market?
I would say the biggest proponent has been digital platforms, fintechs, right? You have fintechs who now do not limit. I mean, prior to a lot of these fintechs, you needed to first have your broker or your asset manager, and quite a lot of these investments were done pushing paper. It's maybe your broker sends you an email, tells you about this company is up in the market, it'll probably do like this, like that. And then you would have to fill a form and signify interest in all of that. But in the past 5 years, you've seen the rise of Bamboo, you've seen the rise of Tracker Chove, GetEquity, and a couple of other players rise first in the local market as well, who have now made this rise or this entry to be done quite easily. I register once, and then at the click of a button, I'm able to signify interest in whether it's a private market instrument or whether it's a public market instrument. And I mean, we're good to go. Everything is done on the back end. The back office handles the entire process. Then you also see that in the past, let me say 5 years as well, you've had quite a lot more upwardly mobile Nigerians who have left the country. And I think the diasporan market is about 10 million people strong, who on average, I mean, according to the US, the average Nigerian family makes about $70,000 a year, which on Nigerian standard qualifies you to be a HNI. So we've started to see from emigration and then towards, for those that have emigrated, the access to still be able to invest back home is like a very, very huge, it's a very, very huge play. And I think quite a lot of investments have been made by startups and fintechs to be able to get us to that point.
Okay. Yeah, but I mean, despite this growth, there's still a long way to go.
Yes.
Because we just have a little mass of the retail market
Yes.
actively investing. What do you think we need to do to get beyond this?
I mean, right now, currently, the active investments or the Nigerians who actively invest are about 2% of the population, right? Ideally, this should be somewhere around 20. So there's still quite a lot that needs to happen on all sides of the value chain, first from regulation. And I know that the SEC has this at the very forefront. The current DG of the SEC has been very vocal about trying to drive retail participation in the market. And so with that, making sure that the market is as secure and less, let me say, risk and fraudulent entities playing within that space. Then we've also seen, I mean, there's many instances from when you talk about the growth of the actual fintechs that are currently enabling this, and where the Bank of Industry comes in, and other federal grants, etc. Then you look at the VCs and those who then invest in these businesses as well. Because the first thing that happens with retail participation has to be around sensitization and education. People need to understand how the market works before they're able to then play in that market. And so they're different, let me call them, there are different players on that aspect, from the actual asset manager or the larger asset managers towards like the smaller players. And with the rise of social media, we've then seen also influencers that are now, let me call them niche influencers. And so niche influencers that play in the financial sensitization space, on the financial education space. And that is something that has started over the past 2 years. And we've seen the rise of, number of entrants because of that. I think quite a lot more just needs to be done in towards deepening that market from the process of the regulation, and then all the way down to enabling those who are currently facilitating this behavior to be able to do this at maybe less the cost, and then or like maybe even more times the speed.
Okay, so for you at GetEquity, you started out with a focus on startups, basically making what was the exclusive preserve of VCs and maybe a few angel investors, making that open to the public, and then you switched to private markets. Why did you make that switch? What was the driving factor?
I mean, we basically just followed the market. So we started out in the period of the, let me call it, startup boom, where quite a lot of companies, we were having quite a lot of companies spring up, and then a lot of people who wanted to have access to invest in those companies. This was just off the back of the Paystack acquisition, Flutterwave becoming a unicorn. Everyone, the average Nigerian, wanted to understand and have access to things like that. This wasn't like the public markets anymore, where you had to wait till it got to a certain maturity. And so within the average Nigerian, you had people who then met certain criteria that I refer to as qualified investors, in terms of the sophistication, the technical know-how of seeing how businesses work and what businesses need to get to that scale where they can then go into the public markets. And so when we started to see this rise, and especially from, again, the diasporan markets, where typically people meet that, on average, meet that qualified investor category, we then started to look at how do we make this easy and how do we make this possible? Because even in venture capital, it's a bit better than how we have it locally, but it has still always been pushing pen and pushing paper. Everything was still done quite a bit manually. And so when we set out to do this, we started out with trying to automate processes that already exist, and then build on top of that to make sure that anyone who meets that criteria is just able to, at the click of a button, invest in a business. And over time, we started to see that there was an even bigger market called the debt market. The debt market on average is about 10 times larger than the equities market, which is being able to invest in businesses. And so the characteristics of debt in itself is it's less risky. It's much larger. A lot of companies the companies that are even playing in the debt space are usually much more mature than the startup space. And so we started this out as an experiment to see if this was something that our users were going to be interested in. And following the data, on average, the amount that investors typically invested in debt was about 5 times the amount that people typically put in equities. And from the moment we saw that, we decided to try this out and try to see how deep this can go. And it's been a year now. We've done pretty amazing numbers based off that. And so while we are still amenable to the equities markets, our core focus now is on this private debt and deepening that core.
Okay. And you now work with asset managers to provide these investment products. What would you describe that relationship as?
Exactly. So when we started out with private equity, which is with startups, we first had partners who I would refer to as accelerators, or maybe some early stage VCs, who in some instances we acted as, deal sourcing for. But we needed to do quite a lot of in-house risk management, deal sourcing on our own end. But the moment we started to get into the debt market, the debt market is a lot more structured. The private debt market is a lot more structured. The moment any deal gets to a point where it gets into the market, you see that there are what are referred to as asset managers who do everything from the risk management. In fact, you even have players around agency ratings who then provide ratings for quite a lot of these companies that come into the private market to request debt. There are rating agencies, there are the collection banks. Like it's so structured that everybody has the role that they play, and then goes down to from the lead arrangers to the co-arrangers, who are the people who have done all of this process flow, everything from doing the risk, looking at the financial books, preparing the financial statements, taking those to the agencies, getting the ratings, and compiling all of this into a proper document that you can then pass on to those we now refer to as distributors. Then even on the distributors, you now have other partners, maybe smaller asset managers or other partner asset managers, who then distribute this to, let's say, their HNIs or other players in the markets, where it now comes to people like us as GetEquity, who then are sort of like a last mile distribution to the retail markets or to retail users. And so our partnering with these different asset managers takes a lot of the heavy load or a lot of the heavy lifting off us. And then we tend to focus on what we know how to do best, which is a digital distribution. And that focus on finding, the end users who are very much interested in this.
Okay. So those are a lot of relationships that you have to manage. And we know that the SEC in particular is like very, very strict with how they regulate the market. So how do all the relationships on one hand and then the products that you have to offer, how do they all fit into the current regulatory framework?
Okay, so one major thing that we're also even grateful for is, so like I mentioned, the SEC has put out the mandate to increase retail participation, and they've been very well about it. For example, the SEC has now put out regulation on the private debt market and what needs to happen before any debt note comes into the market. They have also put out what I refer to as a sandbox for players within this market as well, and which obviously we're a part of. And quite a lot of these things now have structured rules, do's and don'ts, as opposed to, let's say, 5 years ago. There was quite a lot of nuance, and because a lot of things were open to interpretation, you couldn't. I guess I'll say a lot of asset managers or a lot of players, especially the bigger players, would rather just not do because it wasn't worth, it wasn't worth the potential backlash.
Okay.
Because quite a lot of things were open to interpretation. But now, with what the SEC has been able to do with regulation and very clear guidelines, you're now able to see areas that you can play around and experiment with. And then it's also why down from the largest asset managers to even the smaller one, there's always a space to play with. And it now allows for people like us who are, let me say, on the fringe side of the capital markets to be able to have that interaction or have that participation with some of the big name guys that we know of.
Okay. So how would you describe the investment appetite of Nigerians for the assets you offer?
I'd say the appetite is quite large, especially when you start to look at the debt side now. On average, the average, let me say, investment amount so far has been about 25% per annum, which is close to And okay, as of right now, it's even more than inflation numbers. And with what we've been able to see with the stabilization, and in fact, the naira is even appreciating as against the dollar. You're now seeing, for the first time in a long time, in over a decade, where the real interest rate is now even more, or the real rate that you get from putting your money in, the private capital markets is now at a positive. This is about the first time in over a decade that we're seeing that. And so there now is quite a lot more people who are very much interested in being able to tap into that. Where for the first time, your savings are no longer, I mean, this is something that we've always done, or people have always done over the past, let me say, 5-10 years, where you'd be told your savings, it's just better to just leave your money in dollars, because that way at least your money will still not depreciate. But for the first time, putting your money in the capital markets, your money would appreciate even in global values. So we have Nigerians in the diaspora, we have foreign entities who are then looking at investing in our local currency, which in turn then strengthens the currency as well. So we're seeing this economic boom, or we're seeing this deepening of the market, which in itself is sort of like leads to a butterfly effect towards economic boom. You have companies who are then able to have access to capital, who would then be able to grow. And then it trickles back in towards the individuals who had invested in these companies, who then have enough buying power to keep buying what these companies produce.
So just back to the relationship between yourself and then the partners you have to work with. Typically, we've seen a little bit of tension between fintechs and then I guess commercial banks or traditional financial players. In your case, how would you describe that relationship? So it's not just GetEquity. We have Chaka, we have Trove, we have Bamboo, we have RiseVest and the like. How would you describe that relationship between both parties?
I think what many asset managers have realized, and I think this still goes back into our regulators, the SEC and the CBN, prior to let me say 3 years ago, because quite a lot of things were open to interpretation. It was just the rigidity and the friction from the larger players is usually more of, let me say, a cost benefit analysis, in the sense of, is it worth partnering with these or partnering with these fintechs or these startups? Is it worth doing, or the possible backlash and cost from the regulators? But now, because we've had quite a bit more direct guidelines, you now see where, even if it's just as an experiment to just start with, they're a lot more amenable to it. And then I think it's also about the data. We've seen, everyone has seen what the numbers now look like from retail, or what the numbers now look like from fintech, whether it's in the payment space, or it's in the financial public market space, or it's in the private market space. Everyone is seeing that there's actually value in compiling, let me say, small ticket sizes to one instance. And so we've started to see instances where some asset managers are now looking at maybe building theirs, but a lot more people are realizing that it's better to partner, because it's also expensive to build yours. And so I would say, also, with the rise of more of these players, one thing that competition tends to bring about is reduced acquisition costs, right? Because the more players you have, the more desensitization then happens across all of that. Because then again, sensitization happens, people have a lot more options to be able to use. It's why it increases the pie. And so everyone is learning that in real time, that the best way to go around this is to actually widen the pie. Either if you want to go the expensive way by doing it yourself, or quite easily just partnering.
So for GetEquity, you say working on a secondary market type of thing, which is crucial, especially for I guess VC. where there's very few exits. But even for the public markets or the private markets, exits are some things that investors want, especially in our case where a lot of the retail investors may be people who just want to move their money out on short notice. How is that going? What's the progress like? And are you facing any challenges so far?
I mean, as with any market, the biggest challenge is still illiquidity. But we've been able to see some really promising data. For example, the secondary market right now is doing about 10% of the primary market, which is typically somewhat at par with even global standards, right? And so that tells you that the more liquidity that you're able to bring in, the better you're able to widen or deepen that market. And so for us, we started this about 2 years ago. And the numbers or the data that we've seen from this is quite promising that we're now providing this secondary market or secondary liquidity as a service to even other bigger platforms who do not have maybe the technical capacity to be able to do that.
Okay. So I just want to return to something you briefly talked about, which is the potential of the diaspora or the influence of the African diaspora in this. Nigeria has, well, taken a few steps to get the diaspora to invest back home. And we've always had the diaspora investing back home, just not in a more structured manner. How much of a role do you see them playing going forward? What do you think needs to be present to just, I guess, encourage them to invest more back home?
To be fair, like for example, the diaspora market makes up right now, I think about 60% of our volumes as opposed to the local markets. And obviously it just has to do with higher buying power, right? And I think in many ways, access to, for example, digital NINs when I am not able to be in the country to, apply to an NIN. I should be able to do that from, any home office or any Nigerian embassy in the world. I think these are now really good, let me call them policies that are coming into place to say, wherever you are in the world, as far as you are a Nigerian, you should be able to have benefits of being a Nigerian. You should be able to play in the capital markets. You should be able to get into banking in Nigeria, for example. You should be able to get a bank account, even if you haven't been to the country in maybe the last 10 years, for example. Or even if you weren't born in Nigeria or you've never physically been in Nigeria, you should still be able to own a Nigerian bank account for virtue of you being in Nigeria. So some of these policies are coming into play from the federal government and all the way down to our regulators. And I think these go a long way towards helping around deepening that instance.
So 60%
Yes.
going to the diaspora or coming from the diaspora is a lot. Do you think that creates any systemic risk?
I don't think so. And the reason for that being that for a lot of Nigerians in the diaspora, or for quite a lot of our investors, these are people who who are Nigerians, have lived in Nigeria, but have just changed their location. And in that particular instance, you're looking at, especially when you have Nigerians who have moved abroad and now earning that increase or are now earning more than they used to and are putting back home. It's exactly what it is that it's exactly what it is that we always want as a nation. You have Nigerians who are making more money, investing back home, paying better taxes, which the government now sees for revenue. It just makes a lot more sense.
Okay, so let's zoom out of Nigeria. And I mean, Nigeria is not the only market, but that's where you play in primarily
Yes.
right now. There are a few other markets across the continent, and there's the drive to, I guess, make investing in Africa just borderless. So can I from Nigeria invest in South Africa, or can a South African invest in Nigeria or in Ghana? What moves is GetEquity making, or are you making to like just facilitate that?
I mean, yes, definitely. So, for example, one of the things that we're trying to do with that is a pilot in Kenya, where as Nigerians, for example, if you look at even how, the markets within not just Nigeria, but other African countries has been getting better over the past 3 years. You see, Kenya had struggled for a bit, but has then bounced back in within their own economy. And so, as a Nigerian, being able to have access to the Kenyan even private markets is something that is very interesting. The Kenyan public markets has done really well. Ghana in the past year has been spectacular. And so, as an African, I shouldn't be limited to just my market. And then as a global African, I should be able to have access towards that as well. And that's the core of what GetEquity is. It's the fact that we are we should be borderless. I should be able to have access to any of these markets, obviously within reason, but I should be able to have access to investing in some of these private markets as well. And so starting out with Kenya and then also seeing what South Africa has to offer as well, and then Ghana. But for now, the focus is between Nigeria and looking at Kenya as a pilot.
Okay. So a lot of I guess I'll call them companies that basically seek capital through platforms like GetEquity, are like large established companies. But we have smaller businesses that probably need 20 million, 30 million, maybe even up to 100 million naira. They can't really get that easily. Are you building any products to ensure that they can get? And this, I guess, this is particularly important for startups. So we are seeing debt sort of come very close to equity in terms of the funding instruments that startups use. So are you building any specific products for that?
Yes. So what we're doing in this instance, as opposed to how we started, is now working in tandem with the people whose job or the people who are very much trained to be able to handle that aspect, which is other asset managers as well. And so what we've seen is, so we're very good at being the tech or being the digital or tech and distribution platform. They're very good at the underlying risk management, assessment, and all of that. And so what we've decided to do is, and we've had this with a couple of asset managers as well, where we provide the infrastructure across board to be able to, for example, like you said, there are companies who are looking at 50 million, 100 million. And so we've provided that infrastructure to be able to say, the moment these companies are, for example, have requested this amount in, let me call it funding, you're able to do that assessment with your traditional know-how, get ratings, get risk assessment and risk management. And then we just provide you a direct flow towards GetEquity users where once all of these documents are ready, there's just this, your own, let me call it portal or dashboard, where you're now able to directly just upload these details to, and it's dissected to GetEquity and its partner companies.
All right. So inflation is eroding our purchasing power as Nigerians, and that's probably something that plays in the minds of potential investors or even existing investors. How can we sort of combat that? How can we still convince people that yes, inflation is still a bit high, but how you still need to invest or you still can invest?
Okay, so like for example, this year has been really good with that. Like I mentioned, this is the first time in over maybe even 2 decades where you have the actual interest rates coming from the private markets being much higher than inflation rates. So that gives you a positive in real interest rates in the country. And so I would say the very first thing that we've started with now is, just showing that data and showing that this is probably one of the best times to ever invest or to ever long Nigeria, because we have this particular instance now where our exchange rates are amazing. They stabilized now. Our inflation, while going down, our interest rates are being quite good and quite stable. And so I don't think we've ever had a better time to invest in the country.
Interesting. All right. So I guess final question would be just around policies or policy direction. You've mentioned that the SEC has been really strong on getting more people into the market, but 2%, 20%, there's still a huge gap
Yes.
before we get to that point. Are there specific policy directives or just policies that you think would move us to, well, let's say 5% in the next 2 to 3 years?
I think we probably need a lot more security exchanges. Maybe niche exchanges, I don't know. But we probably need a lot more security exchanges licenses. Also, we need to be able to facilitate better ways for people outside of the country, whether Nigerian or not, to be able to have access to our private markets and our public markets as well. And I know that this is something that also, our regulators from both the SEC and the CBN are very heavily invested in. I think that there should be quite a lot more investments in companies who are already towing that line. Because at the end of the day, you spend money to make money. So we need to be able to deepen that sensitization. And it has to start with those who are already putting in the work and already showing that value from doing that work.
Okay, so you previously you were playing around with Web3, especially with GetEquity, but your feels like the focus has changed or shifted a bit. I have two questions on that front. One is, how much of a role can the blockchain play in Nigeria's stock markets? And then secondly would be, why did you make that? Like, why does it look like it's something GetEquity has deprioritized?
Okay, so I always say that the biggest advantage of the blockchain is the fact that it's not limited to geography. It's that anyone from anywhere in the world can have access to it. And over time, we at GetEquity had experimented to try to, solve that, or try to solve quite a lot of the private equity issues through the blockchain. Nigeria went through quite a lot of transformation from our regulators, from directly banning the blockchain to then saying we needed to take a closer look. But now we're starting to see this new, government being very blockchain friendly, and so it's not deprioritized. It's just something that, to go with the market or to go with our regulators, we had to shelve for a bit. But now it's one thing that we're coming back very strong with. I'd say that the biggest form of distribution is going to be on-chain. An example is the fact that the global real-world asset tokenization industry is about $30 billion and counting. And this is completely away from the stablecoin industry, which, when you increase that, goes over $300 billion. And all of this is growing at a steady 30% year on year. I think it's estimated that the real-world asset industry would be about $1 trillion in 2030. And Nigeria is nowhere, in fact, Africa is nowhere to be seen in that instance. So you have global players, and then you have the African private markets, which is doing, in many instances, twice in dollar value what the US and most of Europe is doing, but doesn't have that active play within that market, which is $1 trillion market. It doesn't make sense. And so for us, it's first to get your foundation in order, which is the private capital markets that we've been able to do for the past year, and then take that further towards that new horizon that is the real-world asset industry.
Okay. So for someone who wants to play in the space you're currently in, a startup that wants to play in the space, or maybe already plays, but they're still trying to find your feet, what are your top 3 tips for them?
To be fair, I would say the very first thing is, a lot more asset managers are interested in you than you know. And so it's quite easy to, I would say at this point, cold email someone in the top brass. And there's a very high chance that they'll send a reply, because this is also something that they're very interested in. I mean, everybody's scrambling now because we sort of missed the very first opportunity back in maybe 2019, 2020 to be a market driver. But now we're playing catch up. So I would say this is the second best time to be in the market or to be an operator in the market. And so I'd say, yeah, send an email to any of the asset managers, send an email to us. There's a very high chance that we also at GetEquity will be willing to partner.
Okay.